In this video, I'm going to show you how to decide whether trading with options or on margin is better for your trading needs. Once again, this is your Minister of Capitalism, Brett Davison. And today we're going to be taking a closer look at two of the more popular types of trading out there, margin trading and options trading. You can see that they both have their own pros and cons, so in this video we will be exploring those differences as well as what kind of trader each might suit best. Investing is a journey of hope and excitement. We sometimes get greedy when we think about the idea of making money as we trade, which leads to taking bigger risks in order to make money faster. And when it comes to trading strategies, you have two options: margin trading or options trading. Let's explore what each of these are and how they can help increase your potential for return. Let's look at margin trading first. Margin trading is a way to buy and sell securities using someone else's money. This person is usually a stockbroker. Margin accounts let you enter into positions that are larger than your account balance, so you can take advantage of leverage in order to make more money on successful trades. Margin trading is a unique way for traders to magnify their returns in the market. It has become very popular among those who trade stocks, commodities, and cryptocurrencies. In a cash account, all trades are made with available cash, and sometimes your current stock holdings are taken into consideration as collateral. But since every trade has an equal and opposite reaction on the market, meaning that when you buy securities in a margin trading account, someone else is selling the same position to make your purchase happen, there is always some risk involved for investors who do not have enough equity available at any given time. Margin trading is when, instead of paying for something in one easy payment upfront with the cash you have available right now, you can borrow money from the broker to buy more than what your total amount would normally allow. For example, if I had $2,000 and wanted to purchase a car that costs around $6,000, but my trade-in is only worth about $3,000, then borrowing an extra $3,000 from the dealership or bank will get me into this sweet ride. Margin traders don't always use their own funds to use as collateral like buying on credit does. But they might have stocks put up by themselves, which gives them access to extra purchasing power without having all their assets tied up at once. Let's say that you can invest $2,000 of your money and borrow an additional $2,000 from the broker. And with that money, you buy 200 shares. You'll then have $4,000 worth of stocks from both what you could buy with your money as well as the loan. Let's further say that the shares increased in value by 20%. Because of this increase, the value of your account increased by 40% because you made 20% on your money as well as 20% on the money you borrowed. But don't forget that the same thing can work on the negative side if the stock price went down. Using a margin account might be more risky than you think. A small dip in the market can have big consequences for your portfolio and could result in losing not just what was originally invested, but even more when trading on a margin account. Margin accounts are riskier in declining markets, as skittish brokerage firms can demand that margin account holders add more cash for securities into their accounts in order to cover potential investment losses. When this happens, you can face what is called a margin call. A margin call is a risk you take when trading on margin. When the market goes against your position, brokers can demand more cash or force you to sell any of your positions in order to satisfy that call. A margin call is triggered when your broker notices that you don't have enough funds in your trading account to cover the loan they gave you on margin. If this occurs, they'll liquidate some of your positions to get back the lost value. If you find yourself in a tight spot, it may seem that your brokerage company has more rights to the equity than you do. They could even sell off stocks without notifying you. The broker is like a totalitarian dictator who holds all the power. Even if you were just notified of an increase in margin account requirements and have not yet had a chance to add more money to your account, they can close your trades anyways without any notification or warning whatsoever. Now that we've gone over some of the basics of margin trading, let's look at options trading. An options trade is a contract that makes it possible for you as an investor to buy or sell underlying instruments like securities, ETFs, or even indices in order to give you even more trading options. Options are a great way to invest because you have the opportunity to purchase shares of a company at any time without having to own them. You can also walk away from these investments if they don't work out for what is known as lower risk. Options trading is the process of buying and selling options. Unlike futures, holder doesn't have to purchase or sell an asset if they don't want to. It only needs be in their brokerage account. Options are monetary instruments that derive value from underlying securities. Anyone can trade them as long as you provide your broker with enough information about yourself for authentication purposes during registration. If you're the type of person who enjoys having more control over your trades, then option trading may be just for you. When it comes to options trades, there are two types, calls and puts. The buyer is entitled to buy a particular item at an agreed upon price by paying what's called premium. If they believe that a stock will rise within a certain time period, or if a stock falls to a value below an agreed upon strike price during a specified time, then buyer could sell their position. If this happens, the option seller must comply. An example of a call option. A call option gives the purchaser the power to buy a set of securities, like stock shares, at a predetermined price and time before an expiration date. They have this right, but they are not under any obligation to do so. For instance, if an option holder pays $200 per share for a particular stock, also known as the strike price or exercise price, and the underlying is trading in the market at $100 per share, then it would make no sense to pay that much when they could buy them on open markets. The decision changes, though, with shares currently going for $350. In this case, they might want to sell their call position. If you buy a call, the right to purchase shares at an agreed upon price is yours. The potential for profit goes up as long as the stock's value increases. You could lose money on this trade if the stock's worth falls below what you paid in premiums. A put option holder. When you buy a put, it enables you to sell the stock at an agreed upon price. This way, if the share value decreases significantly below the strike price you bought it at, you would make money by exiting your position, so you can purchase puts if you think the price of a stock will decrease. But you can also buy them to shield yourself against losses if you currently own shares of the stock. The put will give you downside protection if the value of the stock decreases, but if the price of the stock goes up, you can still receive the benefits of the price increase because you own the stock. Of course, you can also combine multiple calls and puts into different strategies. You can also sell options, and in doing so, you become either a call writer or a put writer. Call writers. When you sell a call, you are giving someone the right to buy your stock. When you do this, you receive money up front. This is called premium, and you get to keep this premium so long as the value of the stock remains under the strike price. Put writers. As a put writer, you earn premium as well. In this case, you would get to keep the entire amount of premium so long as the value of the stock remains above the strike price you sold it at. My final thoughts. When it comes to margin trading or options trading, the decision of which is best depends on your risk tolerance and appetite for more increased gains. While there are advantages to trading for both systems, I certainly prefer trading options. I feel that when trading options, you have more potential upside while limiting your risk. That's why we trade with options inside the Empirical Collective. Once again, this is your Minister of Capitalism, Brett Davison. And if you like the cut of my capitalist jib, sail on over to the empiricalcollective.com and join us inside.